which was given from the supplier. Okay. Here there is no receiving a category. That's the only difference here. So see, in case of RCM, I'm of the
Hello everyone. Good evening. Why this video is not working? Hmm, क्यों? Wait. Everyone, how are you? Everything is fine. How many are there in the class? Abhilash, Anjali, Gauri, Manya, Nishita, Pranjal, Snehal, Trisha. Hello. Many more to join? मेरा चेहरा क्यों नहीं दिख रहा है? Hope you are studying. You are revising. Is it? Everything is going good, no? I saw some of the students today in the class, in the college. Good to see you all. Wait, I'll share the screen. I think I need to log in from other device. Wait, I'll log in from my phone. I have to switch up. I have to mute it here. Now you can see my face, right? Okay. So we are uh, in chapter number 7. The chapter number 7 may we were doing this unit where public finance. So we in yesterday's class, last class, we discussed about what are what are the budget, what are the forms, parts of the budget, and what is from where the government will get the income, and what is their expenditure, like this. That we have seen. Today we are going to discuss about the public debt management. Public debt management. Now the government also takes the debt, many kinds of debt, and how they will manage the debt. The government can take the debt from the people inside the country or outside the country, internal debt or external debt. How the government is going to manage this? In emerging market and developing economies, the government is generally the largest borrower government. Borrower. The government is the largest, borrower. Generally, government is the largest borrower. Government debt from internal and external sources contracted in the consolidated fund of India is defined as the public debt. So, what is public debt? The government debt from internal and external sources. What is internal sources? Inside the country, external sources from other countries. External sources contracted in the consolidated fund of India. So that means which came into consolidated fund of India. Remember what is consolidated fund of India? Any amount the government receives, no, that goes to consolidated fund, and any amount that government expends or spends, that is from consolidated fund of India. So public debt, in simple words, means the debt incurred by the government in mobilizing the savings of the people in the form of loans, which are not to be repaid at the future date with interest. Sorry, which are, which are to be repaid. The government will take from the public, general public, and which will be repaid in the future date with the interest. With the interest, government will pay this. Okay. So debt servicing is a continuous exercise. As a portion of the debt falls due each month, the government does not. usually cut the expenditure or raise the taxes to provide the funds to retire or repay the maturing bonds. So this is the one of the important feature of the government. See, we will blame Harshad Mehta. Correct, no? You remember the Harshad Mehta scam? Harshad Mehta, what Harshad Mehta used to do? He was taking bank receipts, creating Nakli bank receipts, and he was giving the bank receipt. See, what used to happen earlier, uh, before 1992 scam 1991, 1992. Before that scam, the scam got exposed. See, what has happened now? This Harshad Mehta used to take money from one bank, and see, actually that was one bank is giving loan to another bank. Listen to me carefully. One bank is giving loan to another bank. Example, bank A, now Canara Bank is giving loan to ICICI Bank. Harshad Mehta think that I am Harshad Mehta. I am in between these two banks. Canara Bank gave the loan to ICICI Bank through me. So they gave me bank receipts. Okay, BR. We call it as BR. This Canara Bank gave me bank receipts, and there was 2 weeks ka time to give this to 2 weeks time to give this to ICICI Bank, Canara Bank to ICICI Bank. What I will do in between that 2 weeks, no, I will put that money into the share market and share bhav badh raha hai. That means the price of the share is increasing. Now what I'll do, I have to give the amount to ICICI, no? I have to give the amount to ICICI. I'll take loan from SBI, give it to ICICI. That initial amount, for example, 10 crores, that initial amount of 10 crores is still with me. Canara Bank gave loan to ICICI 10 crores. That 10 crore is still with me. Okay. So now ICICI I have to give the money, no? I will take that from one more bank and I'll give it to the ICICI. Now I have to give it to SBI, no? I will take loan from one more bank, give it to the SBI. Example, BOB, I'll give it to SBI. I'll take loan again from ICICI, give it to BOB. Getting this? So this is the idea which is done by Harshad Mehta. That means initial that amount which was there, no, that is still with Harshad Mehta. This we started blaming Harshad Mehta that he did Gotala. What government is doing? The same thing, no. No, I'm not supporting. See, this can be done, but putting that into, see what Harshad Mehta scam. I also agree that it is scam. Why it is scam? Because Harshad Mehta, he did put that entire money into share market, which is not allowed, which is illegal. Okay, that amount putting into the share market is illegal. It was not allowed. Now the government, no, government did this issue. Was that okay? Okay. Anyways, what government did? Government will take loan from you, and whenever they have to repay, no, they will take a fresh loan, they repay this. And to repay this loan, they'll take a fresh loan, they'll repay that the later loan. Getting this? So rather, the government simply refinances the debt. In a sense, it sells new bond and uses the proceeds to pay off the holders of the maturity bonds. So new bonds, they will issue the new bonds, take the money, they will repay the old bonds. Productive use of public debt contributes to the economic growth and welfare of the society. So this can be done, but provided productively that proceeds has to be used. The proceeds of that loan, no, that has to be used for the productive use, not giving free. Everything is free to the unproductive. So that is not productive. It is not productive. So productive use of debt is done, then okay, we can do this. What is productive use, sir? Example, whatever loan which is taken, no, is invested into a company that is giving the profit, that is giving a good profit. or that is increasing the welfare of the society, then it can be. So, the public debt management refers to the task of determining by the fiscal and monetary authorities the size and composition of the debt, the maturity pattern, interest rates, redemption of the debt, etc. The overall objective of the central government's debt management policy is to meet the central government's financing needs at the lowest possible long-term borrowing cost and also to keep the total debt within the sustainable level. So they can take the debt. Okay. Their main task is in the monetary authorities, that is the just to say monetary authority will first decide what is the composition of the debt and how the maturity has to happen, in which frequency maturity has to happen, within 1 year, within 3 years, within 5 years, like this. And they will decide what should be the interest rate, how much interest we have to give. Okay. And redemption of the debt. That is how to redeem the debt. The overall objective of the central government debt policy is to meet the central government's financing needs at the lowest possible long-term borrowing cost. What is borrowing cost? See, example, I will take loan from you and I have to pay you 8% return interest. So that 8% is borrowing cost. And also to keep the total debt within sustainable level, it should not go beyond to some extent. Sustainable level में होना चाहिए वो. Okay. Yes. Debt management strategy is based on three broad pillars, namely low cost of the borrowing, risk mitigation, market development. Very important one. There are three pillars. See, before taking loan, no, they will take into account three things. Number one, the cost should be lowest. Lowest cost possible. That means the interest which I am paying, no, compared to other loans, the interest should be very less. That doesn't mean that the one who gave the loan, no, he should not get income. Income should be given, but the lowest cost. So to me, it should be the lowest cost. Interest ಕೊಡಬಾರ್ದು sir. No. It is not like that. The cost has to be there, but it should be the lowest cost to me. Compared to other debt, this is the lowest one. Ancha. Risk mitigation. There should not be any risk. For example, I took loan from you. You are asking me that repayment of the loan tomorrow. Arey, I have already invested. There is probation period, gestation period. So you are asking tomorrow. Arey, you cannot ask tomorrow. If you ask tomorrow, if you have that right, then there is risk. Immediately I have to pay it back, no? And market development. See, the loan which I take, I have to invest in somewhere and that has to give me development in the market. There has to be a development in the market. Okay. The institutions responsible for public debt management are, what are the institutions that are responsible for public debt management? RBI, Reserve Bank of India, which is domestic marketable debt in essence, dated securities, treasury bills, cash management bills, etc. That means these are the instruments which are given by RBI. MOF, Ministry of Finance, they will look after the external debt. So now, internal debt is not enough, sir, or it is costly. Then we will go for foreign debt. Foreign companies or foreign financial institutions, they also give some debt. Ministry of Finance, Budget Division, and Reserve Bank of India. Who is government's bank? RBI. Government, whenever want loan, no, it will take amount from RBI. RBI will get the money from all the banks. There is something called as CRR, cash reserve ratio. That cash, see what is CRR? Every bank, they have to keep some reserve. They have to keep some reserve with the RBI. So RBI has that reserve now. That reserve can be given to the government. Budget division. What budget division does, sir? It will, we have seen in the last class that budget division, they will prepare some finance bill also. Finance bill will decide how much money has to inflow. Other liabilities such as small savings, deposit, reserve funds, etc. All these are the public debt. So the sources of the public debt. the responsibility of managing the public debt of the central government and of 28 state governments, and 2 union territories is entrusted with the Internal Debt Management Department, IDMD, Internal Debt Management Department. So that means the central government and all the state governments plus union territories, their debt will be managed by IDMD. The RBI acts as the debt manager for the marketable internal debt. So internal debts marketable. What is marketable? Marketable means whenever possible, no, they can sell that. Easily they can sell. Now, if I purchase a bond, I should be easily selling that bond. So that is marketable. So nowadays, many of the things are marketable, including bonds. Okay. External debt and bilateral and multilateral loans is managed by the Department of Economic Affairs in the Ministry of Finance. So department is managed by external debt is managed by Department of Economic Affairs in the Ministry of Finance. So I hope you are getting this. What is this external debt? The bilateral and multilateral loans. You know what is bilateral loans? Bilateral loans. Bilateral loan means I am taking loan from 2 or more countries. 2 countries. That is bilateral. Multilateral, more than 2 countries. See that IMF, that is International Monetary Fund. Yes, that is International Monetary Fund, IMF. So that will give you multilateral loan. IMF will take the amount from many countries and it will give me the loan. That is multilateral loans. Most of the external debt is sourced from multilateral agencies, which is International Bank for Reconstruction and Development, Asian Development Banks, IMF, etc. The risk associated with external debt is the depreciation in the value of the domestic currency and the currency of denominated of the external loans, leading to the increase in the government's debt servicing cost. See, if you take more loan from outside, no, that might increase the debt servicing cost. How, sir? I'll give you one example. For example, if I have taken 10,000, okay, if I have taken 10,000 loan, think just one $10,000. How much? $10,000 ka loan from US. $10,000. And they say that you have to pay us around 10% interest. What they said, you have to pay us around 10% interest. They told me that, sir, you have to pay us 10% interest. Okay. I have taken $10,000 loan from US and I have to pay 10%. That means how much I have to pay? Every year, I have to pay $1,000. Correct? No? Okay. Wait. 1K. So every year I have to pay $1K, $1,000. Agree? Yes. I have to pay $1,000. If the dollar value is example 70 rupees, then every year I have to pay 70,000 to US as the interest. What if the dollar rate increases to 80 rupees? I have to pay 80,000. Simply I have to pay 10,000 extra. That is the risk. Again, see, I took $10,000 from US and they told that every year you have to pay us $1,000. That is 10% interest. You have to pay us 10% interest. I agree. So every year I have to pay $1,000 to these guys. Okay. Last year, $1 is equal to 70. That means 70 multiplied by 1,000. I had to pay 70,000 rupees. This year, $1 is equal to 83. So 83 multiplied by $1,000, that is 83,000 I have to pay. Last year 70,000, this year 83,000. Simply there is 13,000 increase. That is the risk which is associated with the external loans. So these are the risks which are associated with the external loans. There are some budget concepts now, very simple concept. Types of budgets may we have. First one, balanced budget. What is balanced budget? Where my expenditure is equal to revenue. Balance. Whatever I have to do as this spending, no, that is equal to my revenue. My revenue is equal to my expenditure. That is balanced budget. A balanced budget is the budget in which revenue are equal to expenditures. Revenue does not fall short of expenditure. In a sense, revenue is equal to expenditure. So remember, balanced budget mein revenue is equal to expenditure. Unbalanced budget. What is unbalanced budget? Where there can be two types of budget in unbalanced, where revenue is not equal to expenditure. Revenue is not equal to expenditure. Example, a surplus budget. What is surplus budget? When estimated government receipts are more than the estimated government expenditure, it is termed as surplus budget. Remember, revenue which I receive, no? Example, government. Revenue which government receives, that is more than expenditure, that is surplus budget. Deficit budget. What is deficit budget? When the estimated government receipts are less than the government expenditure. Now, government receipts are less, expenditure is more. That is deficit budget. Aste Vishya. What is surplus? Where revenue is more than expenditure. What is deficit? Where expenditure is more than revenue. That is deficit budget. Next one, what is the meaning of capital receipts? We already know. We receive it only once. That is capital receipt. See, capital receipts are those receipts that lead to reduction in the asset or an increase in the liability of the government. That is capital receipt. Reduction in the asset. That means I am selling some asset and I am getting the money. I will receive it only once. No. Example, I had this laptop. I am selling this laptop and I got 20,000 rupees. After selling this laptop, I got 20,000 rupees. What is this 20,000 now? Capital receipt. Agree? Why? Because every year, will I receive 20 for this laptop? I have not given it on rent. I sold it. That's why I am getting 20,000 rupees. This asset got reduced. The asset, physical asset got reduced. Income, money increased. So example includes recovery of the loans. Example, government gave some loan. That was asset. No. See, loan taken is liability. Loan given is an asset. Okay. So the given loan is asset. If I recover that loan, complete amount is recovered. Recoveries of the loan is an example for capital receipt. Earning from disinvestment and debt. Earning from disinvestment. What is disinvestment? I had some investment in, example, government had some investment in LIC. Government sold that LIC shares. This is disinvestment and debt. So next one, revenue receipt. What revenue receipt will do? It will neither decrease any asset or nor increase any liabilities. So revenue receipt can be defined as those receipts which neither create any liability nor cause any reduction in the assets of the government. It can be tax revenues and non-tax revenues. Tax revenues. Every year we will receive tax revenue. Government will receive tax revenues. That is revenue receipt. They will receive that every year. It can be non-tax revenue also. What is non-tax revenues? Example, government institutions. Government institutions receive some fees. Okay, that is non-tax revenue. So example, liquor license or mining license or government institutions such as medical colleges. Government will receive that money, no? Any fees the government is receiving, penalty that government is receiving, all these are revenue receipt, which are non-tax. Next one, revenue expenditure. See what happens in revenue expenditure, ulta of revenue receipts. Revenue expenditure is expenditure incurred for the purpose other than creation of the physical or financial assets. So it will not create any assets. Create nahi karega. Assets nahi create karega wo. So example, the police are there, government doctors are there. We have to pay salary to them. Government will pay salary to them. That is revenue expenditure. It happens every year, every month. Okay. It relates to those expenses incurred for normal functioning of the government. Normally, government is functioning. So this is revenue expenditure. Okay. Next one, sir, what is capital expenditure? There are expenditures. These are expenditures The government which result in creation of the physical or financial asset. Example, government gave some loan to another government. Karnataka government, example, gave loan to another government. Okay, Karnataka government is taking loan now. Karnataka government took loan from central government. So central government has the asset. Karnataka government has the liability. To Karnataka government, it is capital receipt. But for central government, it is capital expenditure. Okay. So this includes expenditure on acquisition of the land, building, machinery. So this is capital expenditure to create some physical asset or financial asset. Okay. Next one, the budgetary deficit or overall deficit. What is budgetary deficit? So budgetary deficit is defined as excess of total estimated expenditure over total estimated revenue, is the difference between all receipt and expenditure, both revenue and capital. Overall, it is overall deficit. All your receipt minus all your expenditure. If all your expenditure, total of your expenditure is greater than your total of your income. Okay. Total of estimated expenditure is greater than total of your income, government's income, then that is called as overall deficit or budgetary deficit. Okay. We call it as overall deficit or budgetary deficit. Total expenditure is greater than total income. That is overall deficit or budgetary deficit. Now the question is, sir, what is the meaning of revenue deficit? Kya hai revenue deficit? The revenue deficit refers to the excess of government's revenue expenditure over revenue receipts. Revenue expenditure. Revenue expenditure means every month or every year I am spending that money. That is revenue expenditure. Revenue receipt means every month or every year I am receiving that money. That is revenue receipt. So revenue deficit is equal to revenue expenditure minus revenue receipt, where revenue expenditure is greater than revenue receipt. This is called as revenue deficit. Fiscal deficit. What is fiscal deficit? Last one. When the government's non-borrowed receipt falls short of its entire expenditure. Non-borrowed receipts. So that means I am not borrowing anything. That is non-borrowed receipts. Fall short of entire expenditure. That means my receipt other than borrowed. See, for example, listen. My total expenditure is 200 rupees per day. Think. My total expenditure is 200 rupees per day. That 200 rupees and my total income is 150 rupees per day. Obviously, there is shortage. Listen, my income is 150. My expenditure is 200. 200 minus 150, that means 150 rupees. That means 50 rupees is the deficit. So that is fiscal deficit. For that 50 rupees, I will borrow some money. See, I have to spend means I have to take some money, no? So that 50 rupees, I will borrow from some person. So that is borrowed amount. So that is my total. See, 150 is my income, 50 is my borrowed amount, 200 is my expenditure. There is no deficit. What is fiscal deficit? Except borrowing, that is 150 rupees. 150 minus 200, that 50 rupees, no, that is fiscal deficit. So, see, total receipt excluding borrowings, that nothing but revenue receipts, capital receipt excluding borrowings. So, other than borrowings, all my receipt I have to add. Non-debt creating capital receipt include recoveries of the loan advanced by the government and sale proceeds of the government assets, including those realized from the disinvestment of the government equity in public sector undertakings, PSUs, everything. So can I say that fiscal deficit is equal to total expenditure minus total receipt other than borrowings. So basically you have to exclude borrowings other than borrowings. It can also be written as what is total expenditure? Revenue expenditure plus capital expenditure, total expenditure minus revenue receipts plus capital receipt minus borrowings. Or can I say that revenue expenditure plus capital expenditure? Revenue expenditure minus revenue receipt. What is revenue expenditure minus revenue receipt? Revenue deficit, correct? No. Revenue expenditure is more than revenue receipt, means revenue deficit, plus capital expenditure minus capital receipt excluding borrowings. So this equation, no, I can write it as revenue deficit here. And this I have to write it same. I cannot simplify that. Why? Because there is no name which is given to capital expenditure minus capital receipt excluding borrowings. Capital expenditure minus capital receipt was capital deficit. But here, capital expenditure minus capital receipt excluding borrowings. So there is no name to this. So you have to write it in the same way. This is nothing but fiscal deficit. So basically, what is fiscal deficit? Your total expenditure minus total receipt excluding borrowings. See, receipt can be borrowings also. I gave you the example. My total revenue is 150. My total revenue is 150. But that 50, my expenditure is 200. No. My total revenue is 150. My expenditure is 200. No, 50 rupees deficit hai na wahan. 50 rupees is the deficit. No. So where to arrange that 50 rupees? I have to take a loan. So I obviously have to take the loan. That's why. Okay. So that other than loan, what is my deficit? That is fiscal deficit. So this is about your unit here. So one more deficit. Okay. So there are some, these are what we have already discussed. So these things we have already discussed about this. So some primary deficit. What is primary deficit? Fiscal deficit minus net interest liabilities. So primary deficit is defined as fiscal deficit of the current year minus interest payment on previous borrowings. So that is fiscal deficit. So this year's fiscal deficit we just saw here. What is fiscal deficit? Okay. Fiscal deficit of the current year minus interest payment on the previous borrowings. Expenditure will also include the interest expenditure. Correct? No. Last year's, previously I have taken some loan. On that I have to pay the interest. So that interest, excluding that interest. In other words, whereas fiscal deficit indicates borrowing requirement inclusive of interest payments. No, see, total expenditure here. Revenue expenditure also includes interest payment. Every year I have to do some payment, that is interest payment is also included. You have to exclude that. Ashte Vishya. Primary deficit indicates borrowing requirements inclusive of interest payment. It tells how much of the government borrowings are going towards the meeting expenses other than interest payments. So what we do now? Fiscal deficit minus interest liabilities. So net interest liabilities, interest payment minus interest receipts by the government on domestic lending. What is net interest liabilities? See, government will receive interest and they have to pay the interest. When they will pay the interest, if they have taken loan, then they will pay the interest. If they have given loan, then they will receive the interest. Net interest liability. That means whether I have to pay more or I have to receive more. That is given here. Okay. Primary deficit is equal to fiscal deficit minus net interest liability. Finance bill. Do we know what is financing bill? Finance bill. Nothing but tax related to tax. See, bill produced immediately after the presentation of the union budget detailing the imposition, abolition, alteration or regulation of the tax proposed in the budget. Something related to tax. It can be imposition of the new tax. It can be abolition of the tax, old tax. It can be alteration of the old tax or regulating or giving some extra rules for the tax. So this is finance bill. Next one, outcome budget. So very interesting one, outcome budget. The outcome budget is the progress card. Outcome budget is the progress card because see, last year also we have done the budget. So now, what has happened in the last year's budget? So last year's budget, how it will work today, how it is working, progress card on what various ministries and departments have done with the outlays in the previous annual budget. It measures the development outcome of all the government programs and whether the money has been spent for the purpose it was sanctioned, including the outcome of the fund usage. Getting this? So that we are just need to know that whether the budget which is done, no, which is actually as per the budget which is done, no, which is going to the purpose specified or not. That we have to see. Outcome budget means last year we have done one budget. Whether it is going as per the budget or not, that is required. So this is outcome budget. So nothing but progress card it is, progress report. What has happened? Consolidated Fund of India. Do we know what is Consolidated Fund? Anything, any income that goes to Consolidated Fund, any expenditure that has to go from Consolidated Fund. All revenues received, loans raised, and all money received by the government in repayment of the loan are credited to the Consolidated Fund of India. That means any amount that received by the government that goes to Consolidated Fund of India, and all expenditures of the government are incurred from this fund. All expenditures of the government also incurred from this fund. Next one, Contingency Fund of India. A fund placed at the disposal of the president to enable him or her to make advances to the executive or government to meet the urgent unforeseen expenditure. It can be for flood, it can be for the drought, or it can be in case of natural disasters, earthquake, or man-made disasters also. Contingency fund, President of India, no, he has the right to dispose. So contingency fund enables the government to meet unforeseen expenditure and does not require prior legislative approval. Prior approval is not required, but once it is given, no, later approval is required. Once it is dispersed by the president, later in the parliament, yeah, approval is required. And do we know what is public account? Yes. So any amount which are received by the government, but it's not the income of the government. Remember in last class we discussed about EPF, Employee Provident Fund. Yes. So that is public account. So under provisions of Article 266(1) of the Constitution of India, public account is used in relation to all the fund flows where the government is acting as a banker. Correct? No, government, it's not government's income. Government is acting as a banker. Examples include provident funds, small savings. This money does not belong to the government, but it is to be returned to the depositors. It does not belong to the government, but should be returned to the depositor. That is called as public account. This is considered as public account here. So this is the end of the unit. So unit number 3 is done. Now we have to go to unit number 4. I'll give you 2 minutes. Go through all these points that we have discussed so far and let me know if you have any doubts. 2 minutes. Yes, everyone, welcome. Doubts है कुछ? So here, why the video is stuck? Why my video is stuck? Yes, now it is working. So unit number 4, fiscal policy. Fiscal policy here. So what is fiscal policy? Something related to finance. The government is going to make some policies. The finance related policies, how the government will raise the money and what are the changes the government wants to make in the economy, sometime to reduce the inflation, sometimes in case of the depression. In case of depression, what government will take the initiatives or what kind of steps which will be taken by the government, that is fiscal policy. Inflationary fiscal policy. During depression, the government will take some policies, and at the same time, when the economy is into boom, the government will take some policies to slow down the market. Like this, there are many policies which are taken by the government. So this is called as fiscal policy, something related to the finance. The government, all countries pursue numerous policies to accomplish their economic goals, such as rapid economic growth, equitable distribution of wealth and income, reduction of the poverty, price stability, exchange rate stability, full employment, balanced regional growth, etc., etc. All these are what the objectives of the government. So to achieve these objectives, they do many circus, nothing but policies. The government budget is one among the most powerful instrument of economic policy. Government budget. Government will do the budget from where it has to take money, where it has to spend the money. That is one in economic policy. Okay. So we will classify this government tools into the various parts. So we will divide that into taxation policy and expenditure policy, debt, and finally deficit financing or bridging the gap between the public receipts and payments. Getting this? So we have, the government has many tools. We are dividing that into the expenditure, taxation, deficit financing through gapping the bridge between the receipts and payments. Okay. So we have all these ideas for achieving the goals. So what is the goal? Nothing but economic policy. So we will make some policy to achieve the goals. Okay. Next one. So here, see, when all these tools are used for achieving certain goals of economic policy, public finance is transformed into what is called as fiscal policy. So we have some economic policy. What is economic policy? For the development of the economy, we will make one policy, that is economic policy. That should be backed by fiscal policy. Okay, that should be backed by fiscal policy. Fiscal policy is kind of execution of economic policy. Okay, economic policy will say that we have to develop in infrastructure. We should have a very good infrastructure in India. That is their economic policy. Now, to give that infrastructure, we want money. How to take money now? Fiscal policy. There is fiscal policy to support. Okay, so remember that fiscal policy is mandatory policies which are executed by the government, or I can say that it is deliberate government policy. See, it is the deliberate policy of the government under which it uses instruments of taxation. Deliberate it is. Deliberate means compulsory. Okay. Taxation is compulsory. If your income is so and so, that means if your income is more than the tax slab, such as more than 3 lakhs, sir, more than 6 lakhs, sir, more than 9 lakhs, sir, more than 12 lakhs, sir, more than 15 lakhs, sir, then there are taxations which are mandatory. Okay. And they will do some expenditure also. Now, government hospitals, that is public expenditure, correct? And transfer payments, unemployment benefits, the subsidies, all these are expenditures. For that, what the government will do? Government will borrow some amount. See, public expenditure and public borrowing to influence both the patterns of economic activity and level of aggregate demand, output, employment. Government will do all these activities for the aggregate demand, increase the output, increase the employment. Okay. So here there were some kinds of economists. So earlier there were classical economists there. Now they are modern economist. So what classical economists said, so they believe that the government should not intervene in the economy because the market mechanism makes the economy self-adjusting. Remember this market economy. What is market economy? Capitalist economy. In case of capitalist economy, it's self-adjusting. How it will self-adjust, sir? For example, if there is more demand for one product, then the supply of that product increases. Where there is no demand for some product, its supply decreases. As simple as that. See, if the demand increases, price increases, supply also increases, equilibrium price, that goes on decreasing. So it is self-adjusting. Where there is no demand, supply also reduces. That is also adjusting there. Okay. So it always keeps our economy at the natural level of real GDP. It always keeps at the real GDP. Okay. So we think that the economy is always at the stable prices. Okay. And it always operates at the full employment. See, tends to have stable prices, full employment, where the resources are utilized at their full capacity, and there will be no unemployment. This is what we believe. There will be no unemployment. It will, resources are utilized at the full capacity. The government should have balanced budget, and any deliberate fiscal policies are unnecessary. So it always believes. So classical economists, they used to believe that market is self-adjusting. No deliberate activities are required. It is self-adjusting. But can you recall something? Given to the market, correct. If the rights are given to the market, do you think it will adjust itself? No, it is not self-adjusting. Given right to the market, it is not self-adjusting. Why it is not self-adjusting, sir? Because there is market failure. Market will fail here. So there is market failure. Okay. So the government should interfere now. Government has to interfere. So in 1936, the British economist John Maynard Keynes, remember J.M. Keynes? See, many of the theories in the macroeconomics, no, given by J.M. Keynes. And that too in his famous book. Remember the name of the book, The General Theory of Employment, Interest and Money? What he told, sir? See, in some cases, government has to increase their spending. Okay. See, even in case of a family may, there is a parent, there are parents, and there are two kids. Think that kids manage on their own. So we will give some money to these kids. They will manage their spendings on their own. What if there is some deficit? What if there is some deficit? Then the parents, they have to give the money. So the same way, advocates in the government spending to combat the recessionary forces in the economy and to solve the problems of unemployment. In recent times, especially after being threatened by the global financial crisis and recessions, many countries have preferred to have more active fiscal policy. See, sometimes no one is ready to take the actions. Correct. Government, the economy is falling. Who will take the action? No one is ready to take the action. Then government has to take the action. Government will take some actions here. So In case of recession, in case of overdevelopment also, government has to take some action. So the objectives of fiscal policy. So we will discuss it. At that time, fiscal policy will enter. If there is no one who is ready to take care, no one who is ready to take care, then the government will take some actions. This is called as fiscal policy. So basically, what is the objective of fiscal policy, sir? The objectives of fiscal policy are derived from the aspirations and goals of the society. That means, what is the goal of the society? Maximum welfare, minimum cost, minimum cost, and minimum utilization of resources, maximum satisfaction we have to get. That is the goal of the society nowadays. So we know that it is the responsibility of the government to provide various goods and services like highways, primary education, healthcare, etc. to ensure social welfare. Correct? No. The main objective of the society is we have to get good health, good education, and basic necessaries at the cheap cost. So that is the main agenda of society. So since nations differ in numerous aspects, correct? No, we are different, US is different, so that our objectives also vary from nation to nation. For example, US, they are thinking about the capital development, but we are thinking about basic life, standard of living that has to develop. Okay, but we also have some common objectives. What are the common objectives here? Employment. Here also, in India also there is unemployment. In case of US also there is unemployment. We are struggling to get that full employment. Everyone, they have to get the employment. All the assets that should be employed. And there should not be inflation, too much of inflation or deflation. That means that we have to achieve some price stability. Okay. And the growth which we have now, that should be accelerating. The accelerating economic growth. They are also trying, see, even they are developed. They want to develop more. And we are developing. We have to increase the rate of economic growth, economic development. Next, the income which is not equitably distributed. So that means some are very rich, ultra rich, some are very poor. Some can spend 11,000 crores for wedding, but some are there who are struggling to uh, uh, collect the funds for their basic necessaries, so that there is no equitable income and wealth distribution in India also, in other countries also. Some are ultra rich, some are ultra poor. So the importance as well as order of priority of these objectives may vary from country to country. So, example, in India, we are giving more importance for this. Okay, in India, we are giving more importance for full employment. Everyone should get the employment and income. But US is trying for this one, acceleration of rate of economic development. So they give first priority for this, but we give first priority for this. See, we all have same objective, but the priority is different. Okay, yes. So the governments may directly as well as indirectly influence the way resources are used in an economy. The fiscal policy is a powerful tool for managing the economy because of its ability to influence the total amount of output produced, said gross domestic product. See, the government may directly as well as indirectly influence the way resources are used. So directly, it might say that you should not use these goods, or indirectly, they might indirectly also say that the usage of the goods or usage of the resources, how should be the usage of the goods and resources. So now we are going to understand what happens, how this happens by investigating into the fundamental equations of the GDP. Remember this equation? Remember this equation? Where it is? Four-sector model. In national income, GDP, Y is equal to C plus I plus G plus NX. We have solved this in chapter number 6. C plus I plus G plus NX. So the right hand side, this one, equation shows the different sources of aggregate spending or demand. Correct? Now this is demand. and Y. This is Y. Y is equal to supply, aggregate supply, AS and AD. So what is C, sir? Consumption. I, investment. G, government expenditure. NX, net export. That is export minus import or import minus export. We know that the market demand is influenced by the government actions such as tax rates, government expenditure. The governments can influence the level of economic activity, GDP, by directly controlling G, government expenditure, in essence, purchase of the goods and services by the government, and indirectly influencing C, consumption. See, government has complete control on this G, but they can influence C and I. Influence, to some extent, they will influence. They don't have complete control. Government has no control, but they can influence C, I, and NX. Government has complete control over government expenditure, but they have only influence on consumption, investment, and net exports. Okay, that was about some introduction. Now we are going for types of fiscal policy. Remember, there are two kinds, importantly two kinds. One is expansionary, the other one is contractionary. Expansionary, when we will go for, what is this expansionary? When we will go for this expansion, we will discuss soon. Okay. See, what is fiscal policy? I just told you it is a deliberate actions. So deliberate actions to increase the revenue and or increase the expenditure, or decrease the revenue, decrease the expenditure. Government, sir, you just told that government will try to decrease the revenue. Is it? Yes. When it will try to decrease the revenue, not revenue, but money supply. When it will try to decrease the money supply, if the market is into boom, market is already into boom, then government definitely try to decrease the decrease the money supply, tries to decrease the money supply. Okay, so it will try to eliminate the effect of in expansion and contraction. Why? Because there has to be a smooth flow. Remember, in chapter number 5 we discussed there should be a smooth flow. So too much distortions that we don't prefer. So as we are aware, while pursuing the fiscal policy, government makes deliberate attempts to adjust revenues. I told you, deliberate it is. It's deliberate attempt here. Expenditure and public debt to eliminate the unemployment during the recession and to achieve the price stability during the inflation. Too much inflation, not okay. Depression may employment has to increase so that at least the income will increase so that there is some improvement. There are two types of cyclical fiscal policies or fiscal policy measures. What are the two types? Expansionary, contractionary. We will discuss. First one, expansionary fiscal policy. Okay. So what is this expansionary fiscal policy? You think that the name itself says that expansionary. It is trying to expand. When it is trying to expand the policy, or what is expansionary fiscal policy? Deliberate actions of the government to take the market upwards. That is expansionary. Again, deliberate actions of the government to take the market upwards. Market is into depression. Economy is into depression. It will try to stimulate the economy. That means giving more the importance for the development of the economy. During which phase? Contractionary phase. When the economy is falling beyond some level, the government tries to increase the phase of the growth. So that is contractionary phase mein expansionary policies. Then when we will go for contractionary fiscal policy, during boom, we have to slow down. Correct? No. Expansionary fiscal policy is designed to stimulate the economy during the contractionary phase of the business cycle, or when there is anticipation of the business cycle contraction. Whenever we anticipate that there is contraction, we have to go for expansionary policy. See, when the money contracts or a demand deficient, there is no demand in the market, recession sets in a period of falling the real GDP, low aggregate demand, reduced consumer spending, raising unemployment, To combat such a slump in overall economic activity, the government can resort to expansionary fiscal policies. Government will go for expansionary fiscal policies. Okay, so the government is trying to go to take the demand to the high level. So because contractionary mein there is no, we have seen that in the chapter number 5, fifth chapter mein, we have seen that during contractionary phase, it is government economy is going into the recession. Okay, how does government achieve this? What are the ideas of the government to achieve this? See, during contraction, that means there is no demand, there is no investment, there is no demand for the goods. We have to, government has tried to increase the demand. What government will do? It will try to cut down the taxes, correct? All types of taxes. It can be GST, that is indirect tax, or income tax. So if they reduce the tax, what happens? Extra money that will be there in the hands of the people. So earlier you had to pay 5,000 as the tax. Now you have to pay only 2,000 as the tax. 3,000 is extra there in your hand, no? Spend it. That is an idea of the government. Okay. And the government also, okay, sir, that is not enough. Then government will give you money. Government only gives you money in the form of freebies, so that increase the expenditure. See, increase in government expenditure discussed detail below will pump money into the economy and increase aggregate demand. Correct? No. More money is given in the hands of the public, so that will give the more strength to the demand. Or see, this is one idea, decreasing the tax. This is one more idea, or combination of both. Combination of increase in the government spending and decrease in the personal income taxes. Government spending increases, personal taxes decreases. This is one idea. Next one is contractionary phase, exactly ulta of expansionary. See, contractionary fiscal policy is basically the opposite of expansionary fiscal policy. Contractionary fiscal policy, when we will take it? When the market is into boom. Contractionary fiscal policy is designed to restrain the level of economic activity of the economy during an inflationary phase. If there is inflationary phase, government wants to reduce the pace of growth, or when there is anticipation of a business cycle expansion, which is likely to induce inflation. So if there might be any activity which are influencing, or which is increasing the inflation. So contractionary fiscal policy refers to the deliberate policy of the government applied to curtail aggregate demand and consequently the level of economic activity. Aggregate demand also decreases, level of activity. So the level of economic activity also, they want to decrease that. So contractionary fiscal policy works through decrease in the government spending. So what happens in contractionary fiscal policy? It works. Okay. Contractionary fiscal policy works through decrease in government spending. So government spending, see, here what has happened in expansionary? Government spending increased. Correct? No. Their government spending increased. But here we are decreasing the government spending. Increase in personal taxes and or business taxes. There we decrease, but here we are increasing. Or combination of both. I think I don't have to explain this. Why? Because whatever they have written there, no, that is exactly ulta here. So an increase in personal income taxes reduces the disposable income, leading to fall in the consumption spending and aggregate demand. Correct. An increase in the taxes on business profits reduces the surpluses available, so the demand also reduces. Ashte vishya. To sum up, during inflation or when there is excessive level of utilization of resources, fiscal policy aim at controlling the excessive aggregate spending. And during deflation or during the period of sluggish economic activity, when the rate of utilization of the resources is less, the fiscal policy aims to compensate the deficiency in effective demand by boosting aggregate spending. So they will boost the aggregate spending and they will try to reduce the, they will try to increase boost the aggregate spending, and they will try to increase the demand. They are trying to increase the demand. So this is about inflationary and deflationary. We shall now describe the application of each of fiscal policy tools. So there are instruments and fiscal policy tools that we will discuss. Do one thing, go through these points, these two points here. Let me know if you have any doubts. Don't go anywhere. I'm here. I'm watching you. Yes. Doubts hai coach? Any doubts? Yes. Okay, we'll continue. The instruments of fiscal policy the tool of fiscal policy are tax. We already seen, correct now. So the tax, increase in the tax, decrease in the tax, we can easily uh, we can easily monitor the economic activity, and even the government expenditure, public debt, the government budget. We shall discuss each of them in the following paragraphs. Okay. Government expenditure as an instrument of fiscal policy. Government do the some spendings, correct? No, it's an important fiscal policy tool. Why? Because nowadays government expenditure, no, it is very high. So it can give you some money to increase your consumption, or it will give you subsidy to increase your investments, and it might do some transfer payments also. It is giving subsidy to the businessmen. It is giving some subsidy to the consumers also. It is giving some transfer payment to the consumers. It is giving some expenditure. They are only doing some investments such as on roads or on public expenditure such as the hospitals, any for that matter, public places may. Correct. See, they are doing here expenditure towards consumption. Investment, they are only doing investments. I told you, they'll do some transfer payments also. So that they will do some expenditure related decisions. For what purpose, sir? So they have to see whether they have to expend more or less here. See, they have to spend more. Sometimes, no, the government will spend more than what they receive. Sometimes they will spend less than what they receive. Deliberately, they do this. Okay. See that why do they do this these things just to hold on the demand or to increase the demand or adjusting the consumption. So they are trying to adjust the consumption, or see why the government will give the subsidy for investment, do some more investment and achieve some full employment. Correct. No. See, whatever I told now, see, they are doing some decision for what purpose? Expenditure is more or less. Sometimes they will expend more or less. I told you just now. They might spend more or spend less than what they receive. For what purpose, sir? For regulating the consumption and investment to achieve full employment. That is their idea. When it continue, the public expenditure are income generating and include all types of government expenditure such as capital expenditure on public work, relief expenditure, subsidy payments of the various types, transfer payments, other social security benefits. I told you, no. So all these are done by the government just to increase the demand, or they might decrease the demand. So what are the government expenditures, sir? What is included in the government expenditure? First one, current expenditure to meet day-to-day running of the government. See, government departments are there. Many departments are there in the government. So salary is given to all these guys. For what, sir? To running day-to-day running of the government. Expenditure to meet the day-to-day running of the government. Now, capital expenditure, which are in the form of investment made by the government in the capital equipment and infrastructure. So to do the capital equipments, in expenditure on capital equipments and infrastructures. Government also will invest in some machineries. So government PSUs, public sector undertakings are there. They are also doing some investment. So this is also their idea of increasing the demand. Transfer payments. Government might increase the transfer payment or decrease the transfer payment. We have been discussing this since first class. Correct? No. The government spending which does not contribute to the GDP, because income is only transferred from one group of the people to another without any direct contribution from the receivers. See, unemployment benefit. Unemployment benefit. I don't know how it is unemployment benefit. Unemployment is benefit. Okay. If I'm getting that benefit, then I'll remain to be unemployment. No. Unemployed. Better. No. I'm getting benefit being unemployed. Okay. So transfer payments. If I am unemployed, I am receiving the payment. I will receive the payment. Okay. For being unemployed here. Direct income generation during recession. Okay. During recession, it may initiate a fresh wave of public work such as construction of the roads, irrigation facilities. What happens if they do this? So during recession, government will do some major spending, such as construction of the road, so that many will get some direct employment, some will get some indirect benefits also. Direct employment to the workers, direct benefit to those who sell the cement, bricks, or any this kind construction related materials. That is direct. And the income which is generated by these sellers, sellers of the materials, cement, the seller of the cement, what he will do? He will give that amount to his workers. His worker will spend it on, see, that is circle it is. Example, now your parents, they got some money and they are spending it on you. They gave it to Trisha classes. Trisha classes gave it to me. I will spend it on my consumptions or my work. Correct? No, this is a circle here. So sanitary works, ports, electrification of the new areas, etc. That increases the purchase of the goods. Apart from the direct effect, there is indirect effect in the form of working of the multiplier. So multiplier starts to work here. Excuse me, Krishna. So the multiplier, that means you spend it on me, I will spend it on someone, that guy will spend it on something else. So the income generated are spent on purchase of the consumer goods. Like this. It goes on and on and on. That is one idea. What are the sources of expenditure? Increase in tax? Question mark. We know that if government resorts to increase in taxes, it will discourage people. Correct? No. For example, government wants more money. It increases the taxes. Think. Then, say, I got income, but I gave it to government. So, increasing the taxes, see, example, government did spend more on me so that I got more income. That more income went to government again. अरे गवर्नमेंट आपने दिया है यार, छीन भी लिया. So you gave some money and you snatched it also. It is self-defeating, as increased tax will reduce the disposable income and therefore aggregate demand also. Again, you gave money, you took money. So I thought that I got money to spend, but no, you gave money and you took it in the form of tax. Gone. So it increased in the tax. Deficit budget. So the government should, in such cases, go for a deficit budget, which may be financed either through borrowing or through monetization, creation of additional money to finance the expenditure. See, they can go for borrowings. Government will borrow the money from the public, or they can go for monetization. Monetization means they will print the money, not printing actually, minting money. No, they will start creating some additional money. So that is deficit budget. The former runs the risk of crowding out private spending. Which one? Borrowing here. If government goes on borrowing the money, that will result in crowding out. You know what is crowding out? I'll explain. See, listen to me very carefully. So you should be here 100%. Listen. Crowding out of private spending. That means, example, government wants to spend more. What government will do? Government will take more borrowings. Anyhow, they cannot go for a taxation. No, just now we discussed now. If increase in the tax, that is self-defeating. I cannot go to increase in the tax. Okay, sir. I will not go to increase in the tax. Fine. If I don't go for increasing the tax, then I have to get the money. No, from kahan se laun main money? From where to bring the money? Okay. For that, government will go for borrowing. It will borrow the money from the public sector institution or finance banks. They will borrow money from the banks. Okay. If they borrow, see, government will borrow the money in lakhs, no, in crores, 1,000 crores. Government will borrow money in crores. Okay. If the government borrows money from Canara Bank, for example, Canara Bank say government will borrow money in crores. Now, the funds which were available with the bank, no, that will get diminished, reduced, no. Funds with the bank got reduced. Okay. If the funds with the banks got reduced, then The government has, bank has no money to lend it again. If they don't, they have limited amount to lend. So what they do, they will give it to those who want it. That means they'll give it to those who are ready to pay more interest. That means automatically interest rate of that money increases. Think that you are the manager of the bank. You have only 10 lakh rupees in your hand at the disposal. There are 5 members who want that 10 lakh rupees. You will give it to whom? The one who pays you more, so that interest rate will increase. Other fours, no, sir, we don't purchase it. We don't want that money because interest rate is high. This is called as crowding out. 4 guys went away. No, they did not took the loan. This is called as crowding out. So we are putting them informally outside. So the government can do this crowding out. जा रहा है दिमाग में. Again, I will explain again. Government, they will take huge loan from the bank. So the treasure or the reserves in the bank, that will reduce. If that reduces, there is more demand for money outside. If that reduces, see, the available amount in the bank, that is less. That is very less. But the borrowers are more outside. So the interest rate start increasing. Supply is less, interest rate increases. If interest rate increases, the private people, they cannot take loan. So that is crowding out. Okay. So additionally, a program of public investment will strengthen the general confidence of the businessmen and consequently their willingness to invest. So some program has to be done by the government for the investors to invest more. Public expenditure is also used as the policy instrument to reduce the severity of inflation and to bring down the prices. The government will try something to bring down the prices. So the government reducing the government expenditure when there is a fear of inflationary rise in the prices, reduced income on account of decreased public spending, help eliminate excess aggregate demand. So the government reduces their expenditure, so that will eliminate the excess aggregate demand. So this is one idea. Government expenditure. See, you tell me, in case of recession, what government will do? It will increase the expenditure. During inflation, what government will do? Government will reduce the expenditure. Okay. Yes. Yes. Next one, taxes as an instrument of fiscal policy. Tax as an instrument of fiscal policy. Taxation policies are effectively used for establishing the stability in an economy. Correct. Tax is one idea to maintain the stability. That means high income guys, they have to pay more tax so that they will give more tax to the government, and very low income guys, they are not paying tax. They are getting some deductions. They are getting some extra benefits. How the government will give benefit to them? By taking money from these guys, ultra rich, and giving it to the poor. So the taxes as an instrument of the fiscal policy consist of changes in government revenue or in the rate of taxes aimed at encouraging or restricting the private expenditure. How they will encourage? By reducing the tax. Tax reduced, that means disposable income in your hand is more. If the disposable income is more, demand will increase. The government can reduce the demand by increasing the tax. If tax rate increases, your disposable income decreases. If that decreases, your expenditure or your demand also decreases. Okay, so tax mainly decide your disposable income, which in turn determines the demand and possible inflationary and deflationary gaps. So inflation and deflation can be easily reduced or increased by this tax structure. Okay. Tax structure rate is varied in the context of overall economic conditions prevailing in an economy. Okay. So we know that during recession and depression, what we will do? We will reduce the tax, correct? No. The tax policy is framed to encourage the private consumption and investment. A general reduction in the income tax leaves higher disposable income with the people, inducing higher consumption. So we will induce them to do the higher consumption. Low corporate taxes increase the prospects of the profits for the business and promote further investment. So it will increase the tax increases the prospects of the profits for the business and promote the further investment. The extent of tax reduction or increase in the government spending required depends on the size of the recessionary gap. If the recession is very small, then they don't take these kind of actions. If the size of recession is very high, then they might take some actions. So during inflation, what happens during inflation? Ulta of during depression. Ulta. New tax can be levied. New tax they will levy. The rate of existing tax are raised to reduce the disposable income and to wipe off the surplus purchasing power. However, excessive taxation usually stifles new investment, and therefore the government has to be cautious about the policy of tax increases. See what they highlighted in this para. This para, they highlight that the advantages of taxes, disadvantages of taxes, both. So they did highlight that what are the advantages of the taxes, what are the disadvantages of the taxes. If you increase the tax during inflation, you can reduce the inflation. But one more point, it might go beyond the limit. During inflation, if you increase the tax, that will discourage the people from doing the work. It might lead to depression. It might lead to depression. That's why you should be very careful. Next one, public debt as an instrument. Do one thing, I'll give you 2 minutes. Go through these points once again and let me know if you have any doubts. I'll be back. So now we will continue here. So we're done with all this. So public debt as an instrument of fiscal policy. A rational policy, public debt. So we discussed tax as the public policy, expenditure as the public policy. Now public debt as the policy, fiscal policy. The rational policy of public borrowing and debt repayment is a potent weapon to fight inflation and deflation. So a rational policy of public borrowings. So we can borrow the money for fighting the inflation and deflation. How, sir? Public debt may be internal or external. We know that when the government borrow the money from the people of our country in India, there are people from that people, if we are collecting any money, so that is the internal borrowings. So that is internal debt. And if you are taking any amount from outside sources such as the international, then we call it as external debt that we discussed already. So two types of public debts are available. One is market loan and the other one is small savings. Sir, what is market loan? Open market operation. Okay. So what government does is it will give some treasury bills and government securities. So it can give some treasury bills and it will give some government securities. It can be in various denominations. To denominations, that means 100 rupees, 1000, like this denomination. And it can be for 1 year, 3 year, 5 years, such as. So that is different varying denomination and duration. For financing their capital project and long-term capital bonds. Basically, it is for capital project and long-term capital bonds from the public by selling some treasury bonds. Now, what is small savings? Government, see, you have heard about NSC, National Savings Certificate, and NDC, National Development Certificate, like this. National Savings Certificates are also given. National Development Certificate are also given. So this is the idea of the government to get some savings. So borrowing from the public curtails the aggregate demand in the economy. So if you are borrowing anything from the public, no, it will curtail the aggregate demand. Why, sir? Because they don't have money now. So if governments take all the money from the public, obviously the public don't have money, no. If they don't have money, then they don't spend. If they don't spend, the aggregate demand will fall. The repayment of debt by the governments. So what if they repay the debt? Definitely, what happens is government repays and you are in your hands. The income will increase now. So increases the money and it will increase the aggregate demand like this. So this is the idea of the government, that is for public debt. Next one, budget as an instrument of fiscal policy. Budget. The government budget is widely used as policy tool to stimulate or contract aggregate demand as required. The budget is simply statement of revenues earned from the taxes and other sources and expenditures made by the nation's government in a year. So budget, we know, no. So by looking at the budget, see, that is also one idea. Government will give some budget to the various departments, such as it can be the ports, it can be international airports, basically PSUs, public sector undertakings. To them, they will give the budget and they'll make them to spend less or spend more, like this. The net effect of budget on aggregate demand depends on the government budget balance. Okay, the government budget can either be balanced, surplus, or deficit. People, we know already what is balanced budget. The savings or expenditure is equal to income. So that is balanced budget. What is surplus? Where income is more than expenditure. What is deficit? Where expenditure is more than income. So balanced budget result when expenditure in a year equals its tax revenues for that year. Such a budget will have no effect on the aggregate demand. So whatever the government receives, no, that is spent by the government. There is no effect. There is no effect. The budget surplus that occurs when the government collects more than what it spends, though sounds like highly attractive one, has in fact a negative effect on aggregate demand since leakage exceeds the injection. Surplus means government wants to collect more from you in the form of tax. So it increases the leakage. You know what is the leakage in the economy? That means leakage is nothing but the people, economy, no, that spends more. Economy is from economy, the amount is going out. That is called as leakage. Now, what is injection? Government will put some money into the hands of the people. So that is injections. So remember, leakage is nothing but from the economy, amount is going out. That means from my pocket, we are civilians. From our pocket, the amount is going to the government. That is leakage. What is injection? Government will put money into my pocket. That is injections. So budget deficit, wherein the government expenditure in a year is greater than the tax revenue it collects, has a positive net effect on the aggregate demand since the total injection exceed leakage from the system. Deficit means the government's expenditure is more. That means government injection into the economy is more compared to the leakage. Then it will increase the aggregate demand, obviously. The budget surplus में leakage is more, injection is less, but budget deficit में injection by the government to the economy is more. That means government is spending more into the economy, but the leakage, the government is taking less from the economy. While budget surplus reduces the national debt, budget deficit will add to the national debt. Budget surplus, that means government has more money. Okay, but deficit means government spending more. Already there is debt, government is spending more. That is budget surplus and budget deficit. Fiscal policy for long run economic growth. Okay, for the purpose of long run economic growth, what is the fiscal policy the government has done? We have been discussing so far about how fiscal policy acts as effective tool for managing the aggregate demand. In short run, to help maintain price stability and unemployment levels. Correct? No, we have been discussing about this. So the demand side fiscal policies unaccompanied by policies to stimulate the supply. See, we are trying to increase the demand, more and more of demand, but supply is not increasing. What happens in such cases? So in such case, there is demand. See, in such case, no, what happens is there is demand, but there is no supply. That will lead to inflation. That will lead to inflation. Why? Because demand is there. Supply is not there. Automatically, see, remember chapter 4, unit number 2. Chapter 4, may we discussed that supply being constant, demand increases, price, equilibrium price will increase. Fiscal policy influences the economic growth through its effect on the incentives faced by the individuals and firms. For example, fiscal policies such as those involving infrastructure spending generally have positive supply side effect. How, sir? Because infrastructure means a big spending it is. A big spending which happens in the economy that leads to a big amount of involvement by many number of people that will increase the income of the people and that will have the multiplier effect. Okay. Sometimes government only give the public goods such as education, healthcare, nutrition, correct? No, and development, etc. So it will provide the momentum for the long run economic growth. Obviously, see, the government is giving free education. That means now the household, they don't have to spend on education. Correct. One more is tax. Tax have positive or negative effect. If you increase the tax, that will increase the income of the government. That will spend more. The income government will spend more on public infrastructures. But what if the more tax that will lead to discourage? That will discourage the businessmen, discourage the savings and investments. Okay, so that well-designed tax policy that rewards the innovation and entrepreneurship. Tax and spending policies, example subsidies, can be effectively used to correct the market failures resulting from the externalities. Correct? No, tax and spending policies can be the effective tool to reduce the externality or to increase the positive externality. Increase in environmental taxes. So what is environmental taxes? You cannot spoil or exploit the environment. Taxes increases the cost of the firms and reduce their output. Subsidies on the inputs and support prices to producers. Example, farmers generate higher output, correct? Subsidies on inputs and support prices to the producers. So that definitely generate the higher output. Okay. Fiscal policy for reduction in inequalities of the income and wealth. So the last one, which says that there are inequalities of income and wealth in the country. So many developed and developing countries are facing the challenges of raising inequalities. So there is no inequality of wealth and income. So the government, what it does, it will try to equate between the rich and poor. Okay. Fiscal policy is the chief instrument to influence the income distribution and plays a significant role in reducing the inequality and achieving the equity and social justice. Obviously, we know with the help of taxation, generally with the help of taxation. So, policymakers, what they do in India, so they will go for some socio-economic activities, issues. It can be the unemployment, it can be inflation, it can be poverty, it can be inequality, it can be illiteracy. So what they do, they will do some activities, forcibly they will do some activities so that it will bring some equality. See, if there is poverty and there are some rich people, ultra rich people, take money from them and give it to the poor. How to give it to the poor? With the help of transfer payments. Now there are the activities which are done by the ultra rich, from them take some money extra. How, sir? Tax. See, developing countries, they try to address the socio-economic issues such as illiteracy, poverty, unemployment, and inequality by deliberately charging the tax rates and tax structure and levels and directions of the public spending. Correct? No, it will level the direction of the public spending to some sector. So it has to go to that sector. So government revenue and expenditure have traditionally been regarded as the important instruments for carrying out the desired redistribution of the income. So desired redistribution of the income ke liye. So traditionally we were looking for that. Okay. We shall see a few such measures to how each of these can be manipulated to achieve the desired distributional effect. We will see one by one. First one, progressive direct tax system. We already discussed so many times about progressive tax. More income, more tax. Less income, no tax. No tax. More income, more tax. Less income, no tax. So that is progressive taxation. As and when your income progresses, tax rate also increases. So it has a greater ability to contribute towards the defraying the expenses of the government. Indirect taxes can be differential. For example, the commodities which are primarily consumed by the richer income groups such as luxuries are taxed heavily, and the commodities which form a larger proportion of the income of the lower income groups such as necessities are taxed light or not taxed at all. Correct? No. Indirect taxes may, that what is indirect taxes? For example, GST. GST, in case of GST, high tax for some rich goods such as car, luxury items pay high tax, and some are necessaries such as milk or loose rice. On this, there is no GST at all. So they might charge high tax or they might not charge at all. Carefully planned policies of the public expenditure helps in redistributing the income from rich to the poor section of the society. This we know. This done through the spending programs targeted at welfare measures of the disadvantaged. So now, see, this is about tax structure. No, till now we discussed about tax structure. It can be spending also. What government will spend more or give more money to the poor, and they will take that money from the rich. See, poverty alleviation programs, free or subsidized medical care, that will improve the living of the poor, infrastructure provisions on a selective basis, various social security schemes under which People are entitled to old age pensions, unemployment relief, sickness allowance, etc. Subsidized production of the product of mass consumption. Example, COVID-19 ka vaccines. Public production and or grant of subsidies to ensure sufficient supply of the essential goods. Correct. Now, public production. Example, electricity produced by the government and for mass production, mass consumption it is. So that it is directly given to the public by the government. It will strengthen human capital for enhancing the employability. That means giving free education, free skills. Government gives the free skills just to increase their employability. So choice of progressive tax system with high marginal tax may act as a strong deterrent to work, save, and invest. So there is high tax, then I don't work at all. Therefore, the tax structure has to be why? Because see, if I work, I'll get income. My income is more, tax is also more. Think that there is one rich guy, there is one poor guy. For rich, 40% is the tax. Example, if he earns 100 rupees, then he has to pay 40 rupees to the government. 60 rupees he can keep it in the pocket. Very poor, if he earns 100 rupees, I mean 60 rupees, if he works less and he earns 60 rupees, there is no tax. That means he's also having 60 rupees in his pocket. Rich guy is also having 60 rupees in his pocket. Then where is the difference between rich and poor? There is equality, but that will discourage. Rich will stop being rich now. Why I should be rich? Tax is more, government is eating everything. So additionally, highly redistributive fiscal policies with excessive generous social programs can reduce incentive to work and save. That's what I said. If the government goes on giving money to the as unemployment benefit, if you are unemployed, then you'll get the benefit. So that's why I remain to be unemployed. No, I'm happy to be unemployed. So these are some of the fiscal policies and limitations of the fiscal policies. So we have some limitations here. Okay. Kya kare? We'll do one thing. We'll finish this in the next class because I have some other commitments. We'll finish it in the next class. Okay? If you have some doubts, you can ask. If you have some doubts, you can ask me now. Yes. So I hope there is no doubts. No, sir. Sanvi says no, sir. Thank you. Okay. Everyone, thank you so much for your patience tonight. If you have some doubts, please do note it down. We'll meet in next class tomorrow. Thank you, everyone. Disha ji, thank you so much. Snehal, thank you. Okay, everyone, take care. Bye. Krishna Vasudeva Hare Krishna Jai